Right, good morning to our wonderful audience again, and welcome back to Boutiques on Wednesdays. Federal Reserve Chair Jerome Powell on Monday said that they will not wait until inflation hits 2% before they start to cut rates, driving hopes that interest rate cuts are definitely nearing. Investors also ponder what a Trump victory will mean for world markets, especially emerging markets like South Africa, with Trump now leading in some of the swing states after a disastrous big boy press conference by Joe Biden and the recent assassination attempt on Trump. Markets are mainly driven by consumer demand, and it appears as if consumers are still very resilient. But what is the reality? On the local front, we've seen a significant SA election bond rally in June. Is it too late to invest in bonds? We've seen net foreign buyers of our bond market. So maybe not they're still buying, or they are definitely buying. Lots of optimism on the SA economy. And tomorrow we will look if SARC will announce a rate cut on Mandela Day, with eyes also on President Ramaphosa's address to Parliament on government priorities. Today we will continue discussions on SA fixed income and SA equity, and we are very fortunate to have with us this morning Matthew Whitelaw from 361 Asset Management, joined by his colleague Jackie on the line as well, that will drive the slides, and very familiar to you all, Philip Bradford from PortfolioMetrix. Good morning, gents. Really great to have you with us this morning, and thank you so much for your time. How are you keeping? Oh, good. Philip, you ready? But it's first Matthew. Jackie, if you're ready, you can actually start with the slides. And while we're getting the stuff onto our audience, a quick reminder, the Q&A bubble at the bottom. If you have any questions for the presenters, you're more than welcome to post it there. We'll keep an eye on that. And Matthew, we're ready for you. Thank you so much for your time.
Sure. Thanks very much, Eugene. And thanks very much for everyone joining this morning. I think I spoke about, 6 months ago, the last time on Boutiques on a Wednesday. Just going to run through a few slides on, some of our views. Some have changed, some haven't. So just going to go through our general views on the market. I think from a commodity perspective, our view is relatively unchanged. We think demand is weak across the board. The big focus for us is, on the supply side of some of these commodities, which commodities are supply side constrained and which aren't. I think manganese is a good example. In recent times, you've obviously seen a 10% outage due to a cyclone in Australia. We think manganese prices can continue to remain elevated for the next 6 to 12 months. And when we look across the commodity complex, things like copper, met coal, and iron ore, these are good supply side stories, and we think these commodities can remain relatively resilient. When we look at, even though there's these rosy long-term demand pictures, stuff like lithium, nickel, cobalt, we think could be in bear markets for, the next 5 to 10 years, given what the supply outlook looks like. And, we don't see, or we don't forecast a massive demand recovery anytime soon, particularly out of China. So, we're very selective on the commodity front, and deciding which commodities, we want exposure to and which ones we don't. I think just flipping to the next slide, and it's probably the question that's been the most topical, and that I certainly get the most from investors, and that's is this the bottom in PGMs? I think there's a lot of focus at the moment on BEV penetration rates and slowing BEV penetration rates, and while that's the case, our view is that it's a little bit of a red herring. What we actually think is the most important thing and the real driver of price at the moment is Chinese loadings. If you look at Western and European OEMs and auto manufacturers, they're putting roughly 3 to 4 grams of palladium per vehicle into these cars. And then also, obviously, the JVs with Western and Chinese OEMs, they're also doing 3 to 4 grams. The local Chinese OEMs that are supplying both the local Chinese market and also the export market to countries such as South Africa, we think are putting in 1 to 1.5 grams of palladium loading. So more than 50% less than what the Western OEMs are doing. And this has significant implications on the PGM market. And if you look at, even driving to work, if you look at how many Chinese vehicles are now, on the roads and taking market share from Western OEMs, there's a lot of delta here, and we think that continues given the price competitiveness of Chinese autos. So, ultimately, how does this play out? We think there has to be supply cuts. I think we've been calling for it for the last 6 months. Every day that goes by, unfortunately, is making things worse. And we think North American supply has to come out. These palladium-rich mines, we think the market is oversupplied and will continue to be oversupplied. And we think this is what the market's missing. So until we see supply cuts, it's very hard for us to get that constructive, on PGMs. Then just, in terms of rest of Africa, I spoke about it last time that you had these currency regimes where you had an official rate and an unofficial rate at 40-50% spreads, and that was just completely unsustainable. And ultimately, currencies needed to be devalued to get to the unofficial rate and try and, normalize, FX in these countries. I think that's exactly what this is exactly what you've seen over the last couple of months. We think Egypt's in a much stronger position now than it was previously. You've had the devaluation. You've had quite a lot of investment, foreign currency investment from a number of their allies in the Middle East. And you've seen quite a lot of, you've seen that currency stability coming through. I think Nigeria's, been a lot tougher. It's been a lot more volatile. They still don't have the FX reserves. The Dangote refinery, which was meant to help, is still importing crude oil. And we think a number of Nigerian companies still need to be recapitalized. So Nigeria, we're still a little bit concerned about, but things are improving slowly in Nigeria. And then we think Egypt could have turned the corner, and you could see a period of decent stability in Egypt. So we're not as negative as we were on the rest of Africa. Still very selective between regions, but things are moving in the right direction there. Then just in terms of, moving locally, this is our load shedding modeling, for 2025. If you see a positive number, that effectively means we have excess capacity, and a negative number means load shedding. If you see -2, that's obviously level 2 of load shedding. And simplistically, ultimately going into 25, the magic number is roughly 60%. For the energy availability factor. At 60% EAF, that means at any renewable load factor, you should have no load shedding in South Africa. Eskom's done an extremely good job over the last couple of months. They've brought the energy availability factor at the moment up to 62%. So you should see limited load shedding for the rest of this year if they can hold that, and then no load shedding in 2025, which obviously extremely positive for the domestic market. Then, the other problem child's been Transnet. And we think, in terms of Transnet, the big issue has been CapEx and massive CapEx underspend over a number of years. The positive is, and it is off an extremely low base, we have seen CapEx base, and we have seen it tick up gradually. We obviously need CapEx to ramp up materially from this point. But we're seeing a lot of positive signs. We think, private rail operators will be running on Transnet tracks by the end of the year. And this will give much needed additional revenues to Transnet to ultimately reinvest that money in CapEx. We think the path for Transnet is trough volumes. We think we're in 2023. You'll see gradual improvement in 2024, and you should see quite a material improvement in 2025. So it's still quite a long road to go for Transnet, but we are a lot more positive, and we are seeing the green shoots coming through on Transnet. And just in terms of inflation, I think the biggest components for inflation for the majority of South Africans is obviously food and transport. We've seen very good stabilization in both of those. I think even when you look at the oil price, OPEC have done a good job at holding the oil price in this $80 to $85 band. And with the significant amount of spare capacity out the market, we see very limited scope, barring an all-out Middle Eastern war, for a spike in oil prices. So we think, inflation's relatively subdued. You've obviously had a good election outcome, which is, positive for the rand. We see no reason why this arb shouldn't cut tomorrow. We don't really see the reason for them waiting to September, although we do have a hawkish central bank, so probably will be September. But we wouldn't be surprised if we see a rate cut tomorrow, and we think that's obviously positive for sentiment. But ultimately, the difference between cutting in July and September, we see no real reason for them to wait any longer to get on with the rate cutting cycle, given that the Fed looks like they're going to cut 3 to 4 times this year. The labor market in the US is definitely weakening. So it's just a bit unfortunate maybe with the timing of the Fed meetings and the SARB meetings, but we would like to see a cut tomorrow. So then just, turning to positioning and how we're looking at things, the big swing in the portfolio over the last, say 3 to 6 months has been the shift from rand hedges, which, includes commodities and pure rand hedges, shifting that into domestic equities. When we look at rand hedges, the only real rand hedges that we are constructive is Naspers Process. We think the rest of the rand hedges, Bidcorps, Anheuser's, Richmonds, have got low to mid single digit constant currency growth this year. We have a strong view on the rand. We think the rand can get stronger. So in ZAR, you're not going to get much earnings growth out of these companies. Whereas in Tencent, we think earnings can grow 25%, for the next 3 years. And it's off a much lower multiple. So still very constructive on Naspers Process, underweight basically all the other rand hedges. And then, as I've spoken about in the resource space, very selective. And that's how we funded our, domestic exposure. And if we just flip to, where we're looking on a sector basis, our large overweights are obviously in Naspers Process. As I've already spoken about, we have a big, overweight, probably the first time in, a very long time we've been overweight retail. We do think rates will be cut, even if it's September. And, a lot of the starting multiples on a number of these businesses are at, levels we haven't seen since Nenegate. Our view on South African equities in general is that 2024 to generate returns will largely be a multiple re-rating. And that's, what we've already seen. We think there's another 10 to 15% in some of these, businesses for their multiple to re-rate. We're not expecting great earnings, especially this season. But 2025, you're going to have rate cuts. You're going to have a stable Eskom. Sentiment is improving. So we think 2024 is a multiple re-rating year, and 2025 will be an earnings year for these South African companies. And then, on the underweight, it's in resources. It's largely PGM underweight and diversified mining underweight. We still have a chunky weight to the gold sector. We wish some of these gold companies would track the gold price a little bit better. But we still have an extremely constructive view into this rate cutting cycle for gold, and think that can continue. So still running a chunky weight in gold and underweight the rest of resources. The other small underweights there in property and telcos. A lot of the property sectors either too small or has a lot of offshore property. Rates are coming down, but we're very selective on our property exposure. And then in the telco space, probably less underweight than we've been in a long time. We have built a little bit of a position in Vodacom, but still underweight MTN. A little bit concerned about MTN Nigeria and whether it does need to be recapitalized. So then, just in terms of performance, we've had a strong start to the year, and performance looks good over all time periods. We obviously went through the process change around 5 years ago, at the end of 2018, and that's done extremely well for us. And I think, the important thing to highlight on performance is that it's been consistent over the last 5 years. We haven't had a negative year on a gross basis. And, this hasn't been a fund that's, had a plus 20% year on the benchmark, minus 10%. It's been consistent outperformance over time, and that's ultimately what we've been striving for. And, when we look at, performance going forward, it's the first time we are constructive on South African equities in a long time. I'm sure it's and the starting point on Naspers Process is relatively attractive, and a number of these commodities are looking, even on the PGM sector, we think we're probably 6 to 12 months away from basing in the PGMs. So we think we could get a relatively good period for South African equities going forward. Obviously, our goal is to get alpha, but it would also be nice to get a bit of beta, and we think the market's got a relatively good setup going forward. So that's all my slides. I'll obviously hand back to Eugene and to Philip, and happy to answer any questions later on in the presentation.
Many thanks, Matthew. There are some questions coming in. We'll deal with that after all the presentations. Thanks for that. Stay on the line. We'll get back to you. Philip, you're all ready to go, I see. Thank you so much.
Great. Thanks. Just shout out if you can't see the slides, Eugene. So yeah, I'm going to whip through this pretty quickly. Matthew's very kindly covered some of the stuff on South Africa in particular. And a lot of the questions I'm getting at the moment are around, is it too late to invest in bonds post what we've seen, and because we've had quite a strong recovery, obviously, post-elections. And just very briefly, there was a lot of pre-election worries, and we saw almost from the day after the budget speech this year, which was quite positive, investors sort of took chips off the table and said, hang on, these elections are coming. And in the end, it actually became quite exciting, obviously, election-wise. And what we saw when the MK and EFF started raising their heads, we had this MK-EFF effect. And we saw bond yields sell off quite dramatically with no real reason other than investors were a bit worried about the elections, because globally it wasn't as much of an issue, even though we'd had treasury sell off. And then pre the elections, we started seeing the rally happening. So almost a week or so before the elections, there was a little bit of a sell off again. And then post elections, we've seen bond yields come down quite significantly. What did this mean for your investments? Well, basically anything that said South Africa on it did well. From cash, well, obviously cash did what it was going to do, but bonds, equity, and property have all done quite nicely, and the Rand's done 4.5% during that time. This is to the end of June, where globally the assets, even though equities have continued upwards, the heat's come out of that because of the stronger Rand, which is a good reminder to all of us who've lived through times of Rand strengthening, not only Ramaphoria, but even over the last 20 years, we've seen the Rand come back quite strongly during these sorts of periods. What also happened was we saw South Africa. Here you can see the South African 10-year bond. If you compare it to Brazil, which is probably our closest emerging market peer on the same ratings from a credit rating perspective, they've actually been weakening while we've been strengthening. So not only have we done well against the dollar, etc., we've actually done well against other EMs, mainly because they did much better than us last year when we were getting smacked during the Eskom load shedding and Lady Russia type scenario. From a fund perspective, for those of you, many of you invested in our portfolio dynamic income fund, we've managed to catch pretty much most of that rally. We invested quite aggressively from February onwards into April, and we've got just over 9% up since that low in the middle of April, and that's to the end of last week. Over the longer period now, I had many of you asking me, when are we going to see these double-digit 12% returns you were talking about for so many years? And really, you just had to wait for some of the risk to come out the system. 12 months returns are up to about 13% at the end of June, and about actually looking, as of the end of last week, about 16% over 12 months. Now, that's all very well. That's the past. So what's going to happen in the future? And the biggest question, as I mentioned earlier, is it too late to invest in South African bonds after the elections? And well, I think the bigger question to ask, actually, this is what we sit and ask ourselves every day. Bear in mind, we've been on the right side of quite a lot of this. Is it too risky to not buy South African bonds at current yields? We don't believe that you should be fully invested. It's definitely not. The risks happen and things can pull back globally in particular that could knock South Africa back a little bit. But I'll unpack it for you at the moment, because how do we go through this decision process? And just to sort of spoil the story right at the beginning, really, what do we know right now? We know that South Africa is better off after the elections. I mean, we couldn't have imagined a better election outcome. It really couldn't have been. It's never perfect, of course, but it's definitely the best outcome we could have imagined, and better than I think anyone would have imagined going into the elections. Secondly, foreign investors, as I'll show you a little bit later, are now much more positive on South Africa. We found the longer term investors actually were starting to buy South African bonds just before the elections. But a lot of your banks, hedge funds, other investors who can't take the kind of longer term views that we do were quite negative and have now changed their views to be positive on South Africa, especially relative to other emerging markets like Brazil. The US and South Africa, our interest rates are likely to come down soon. It's more when than if, and I'm pretty sure everyone would agree on that front. And then importantly, South African bonds are still cheap. I'll show you just now how cheap, but they still are giving you a significant premium, risk premium above cash, inflation, etc. And importantly, they haven't yet factored in rate cuts, which is really the thing we should be focusing on going forward now, now that the political noise is out of the way. So I've shown this slide in different formats before. Most importantly, we've lived through very tough times over the last 10, 15, 20 years. It's been a terrible environment actually for South Africa. This is the Rand in orange here and bond yields in the gray color. Bond yields were 6.5% back in 2013. They're now just under 12% again. So it's been a bad time. We started around this time when the Rand was around 11 and bond yields were around 10 when we managed this portfolio. And importantly, we've actually managed to perform quite well during this time, because if you look, and I've shown this before just very briefly, this is US Treasuries in Rands, including the Rand appreciation over the last 20 odd years, just over 20 years now. You've done 515% if you'd bought US Treasuries over since 2001, including the Rand appreciation. South African bonds have done 715%. So your 100 Rand is now worth 815 Rand. So despite a terrible environment, including the Rand appreciation, you've still been better off in South Africa. Now, why is that? Well, it's simply because when your interest rate more than factors in currency depreciation, you're going to get a better return in rands. And this is consistent. This is not just the last 10 years. This is the last 40 years. Here, over the last 9 years since we've been managing this portfolio, US Treasuries with the depreciation from 11 to sort of just under 18 at the moment has only given you about 40%. SA bonds have given you about 100%. And then we've done about 130 odd % in dynamic income fund as well. So it's actually been, despite the Rand depreciation, despite all the trouble in South Africa, you've been paid to invest. So importantly, we've managed to do well in a bad environment for bonds. So this is just highlighting again, bonds over this period have done just over 100%. The SA bonds have beaten equities by 40%. It's beaten other asset classes by a long way. It's beaten inflation. Your multi-asset income category has done 88%. So the multi-asset income category, the tortoise has beaten equities by nearly 30% over that period. And then our portfolio has done significantly better than that, looking for different opportunities in the market. The other observation as well is inflation-linked bonds have actually done exactly the same with inflation now. And I showed this a month ago that underperformed inflation. So inflation-linked bonds are not the panacea that are going to solve all your problems. Actually, bond yields are higher than inflation-linked bond yields, and they should still continue to outperform. The other thing to note here is the multi-asset income category has beaten the multi-asset high equity category by quite a sub margin over this period as well. So high equity has only just beaten cash over the last 9 years. If you're in the ASISA multi-asset income category, your average return, you can see here over these years has been quite good. This is on a 3-year calendar returns. And then that's been the top performing fund across these areas. So you could have got as high as those on your 3-year calendar return basis. And that's just a nice little brag has been actually our portfolio over that period. So there's been really good opportunities to be had, and you've been paid very, very well to rather be in income, to be less risky rather than in equity. So what's the outlook from here? It's all very well looking at the past. What are we expecting? I'm not going to spend too much time on this. Matthew's spoken about it already, but we started to see some improvements, some green shoots. We know for one, Eskom was our big problem last year. We can see now that just in 2023, that private power has added on 4.5 gigawatts, which is essentially the same as Medupi when it's working. Okay, so private power just improving the licensing threshold. That's the government did get that right. They reduced the regulations, and private investment without the government having to spend a cent has actually to be able to bring on in 1 year the equivalent of a power station that's taken many years to build and hasn't done very well. But also what we've seen now is that essentially counts to reducing load shedding quite significantly, and the risk of load shedding is reducing a lot going forward. These kind of factors are making foreigners see us a lot more attractive. We're starting to see foreign flows come back into South Africa again, particularly into the bond market. It becomes a much easier trade, a safer trade, both from a currency and a bond perspective. It's not gangbusters flowing money back into South Africa yet. We've still got quite a lot to fix. But importantly, the yields are high enough for investors to look at us and say, hang on, it's worth giving South Africa a bit of a chance at least. But we don't want to just focus on South Africa, because actually the thing that counts us a lot more and impacts South Africa is what happens globally. So what we need to look at is saying, okay, the biggest trend and the biggest thing to watch is US inflation is still coming down, and that means that they are likely to start cutting rates eventually. It's sometime this year, hopefully, but once they start doing that, that will release the ability for the Reserve Bank in South Africa to start cutting rates. If we don't cut rates very aggressively, actually that will probably cause the rand to strengthen quite a bit. So we don't want to cut our rates too early, but we will definitely, once the US starts cutting rates, it should allow most of the other central banks around the world to cut. Now, how much can they cut? Well, I'll show you in a moment. Importantly, as bond investors, and any investor, to be honest, you need to understand what's in the price. It's all very well thinking what's going to happen with rates, etc. But what we're still seeing at this level is bond yields. The longer dated bonds are between 11 and 12%. And at this level, historically, on a next 2-year basis, if you had bought bonds at this sort of area, you'd be looking at an average return of between sort of around about 15% on average per year over 2 years. And it could be higher or lower. If bond yields are a little bit higher, like they were just a couple of weeks ago, your expected return is closer to 18% per year out of fixed rate bonds. Now, that doesn't mean you must put all your money into them, but it does mean that there are very good, very low risk type returns that can be had. It's going to be more volatile than cash, that I can assure you, but you are getting paid a hell of a lot more than you are at cash right now if you go and buy long dated fixed deposits, which is essentially what bonds are. Historically, if you've bought bonds, the longer dated bonds at these sort of levels, your returns, this is when they were just over 12% a few weeks ago, your returns would have on average closer to 18%. But importantly, we hear a lot of narrative around South African equities being cheap. But of current PEs at the moment, I'm not looking forward PEs here, but just current PE, if you applied a similar lens to South African equities, your 2-year annualized returns after the bounce we've seen in equities to the end of June is actually averages around 8% per year for 2 years. That range could be anywhere from 25% to noughts, because equities are a lot more volatile. But interestingly for us as asset allocators, we're still finding on a risk-adjusted basis, we're getting a better return, we think, out of bonds. But on an absolute basis, we actually think we might still get potentially better returns if South Africa continues to improve. The All Bond Index sits somewhere in the middle, and it's not necessarily your best investable benchmark. I'm going to whip through this pretty quickly. The bottom line is that bonds are still quite cheap. We're still getting over 6% out of the All Bond Index in real terms, and significantly above cash. This applies when we look at South Africa versus other emerging markets as well. This is the 10-year bond, and you can see versus other emerging markets, we still got in a risk premium. So South Africa's improved, but it has still got, I think, some room to go, which means that you've got quite a risk buffer by investing in our bonds. If we look at where we are right now, the bang for buck, in other words, how much yield are you getting for taking bond duration? It's actually higher than it was in the middle of COVID, and it's higher than it was in the middle of Nenegate. So the extra yield you're getting for taking a little bit of bonds and a little bit of volatility at the moment is higher than it was during those previous crises. It wasn't as high as it was in March this year and May last year. We were buying a lot of bonds at that sort of time, but it's still actually at more attractive levels than in the middle of COVID, believe it or not. So we think rate cuts are coming relatively soon. What you need to understand with rate cuts, of course, is, again, as I mentioned, what's in the price. The bond yields, first of all, haven't factored in rate cuts yet, which is great. So you're not too late, I think, to take advantage of that. And then importantly, I've shown this before, but what it really tells you is that you need to start fixing your rates before rate cuts begin. If you wait till after rate cuts begin, the returns will have come already. So we've already started seeing the market thinking about rate cuts, but it definitely hasn't factored in large rate cuts in the South African environment and global environment yet. The other thing to understand is income fund returns that are pretty much invested in credit are highly correlated to interest rates. When interest rates are coming down, your yield of your income funds typically come down. So you need to start looking at fixing rates at these levels. And that's pretty much what we've done. The yield of the portfolio is 11.8 actually at the moment. This is showing it when it was 11.7. What's nice about that is in a relatively simple rate cutting environment, if bond yields rally a bit, you're looking at returns probably in this sort of a range. But even if things go wrong from here, if something falls over, something happens in South Africa or even globally, we're still looking at positive returns. So even if rate hikes happen from here, we should still be giving reasonable single-digit returns. And this is quite useful for you as investors saying, okay, well, even if I get my timing a little bit wrong, or if something goes wrong from here, we should still be fine because the running yields of the portfolios are so high. We've steered away more and more from credit type investments as well in South Africa, where simply because we're getting better yields out of the most liquid, best quality credit assets in the country, which are the government bonds. When we do take credit exposure, it's pretty much to the banks. We focus on too big and too important to fail. We really understand as bond investors, you're lending your money to other investors, to a company or a corporate. And we really don't need to move outside of the banks. The yields are so high that we're getting out of the most liquid, best credit quality fixed rate assets at the moment that you actually don't need to chase credit yield in riskier type companies. So just to whip through that, my time's probably up. We got a current yield of 11.8, a gross yield. So that's before fees, but that's inflation plus 6.6. That's pretty much that's better than US equities have given you in history. It's similar to what the SA stock market has done, which was inflation 6.7 over 130 years, which has been the best performing stock market in the world. So bond yields are priced to give you with much greater certainty an equity type return. We think it's too risky, particularly on a 2 or a 3 year basis, to not have fixed rate bonds in your portfolio at the moment. You might pick up a bit more volatility than cash, but we think you're going to continue, as you were during the bad times, you're getting paid a much better yield to just pick up a little bit more volatility. As I've mentioned before, it's a bit like turbulence on an aeroplane. Investors need to fix rates before rate cuts begin. So don't wait until the SARB start cutting rates. It'll be too late at that point. And really the way we've designed the portfolio, I often say it's a bit like having a 4x4 vehicle. You need to be able to be positioned to do well, even when there are potholes in the road ahead of you. You can't avoid tough times that come your way. And we've been through much tougher times than we're likely to go through going forward over the last 12 years. So we've positioned the portfolio really to take advantage of what's available right now. But even if things go wrong, we should be still just fine over that period. That's the end of my presentation, Eugene. I'm happy to take some questions if there are.
Yeah, Phil, thank you so much for that. A lot of interesting questions coming in from the audience as well. Yes, like Phil, every time I see your presentations, I get a bit anxious. I need to be in your fund. But here's the thing, and I mean, Matthew also mentioned it seems, Matthew, that you may be expecting a rate cut tomorrow. Phil, I'm not sure if you are all that positive if we're going to see a rate cut tomorrow. But here's my question. You illustrate it's not too late to invest in bonds in your fund positioning, all that. But if we were to see a rate cut tomorrow, and if I'm not invested in your fund or SA bonds, and we do see another rally, will it not then be too late?
No, well, again, remember a rate cut is short-term cash rates, okay?
Yes.
If I'm buying a 20-year bond, I want to know what the interest rates are going to be for the next 20 years. So normally what will happen is once you're more interested in what the Fed says or the Reserve Bank says than what they do. So you want to get a feeling of what they're going to, I almost don't care what the Reserve Bank does tomorrow. It might sound crazy. I'm more interested in what they're going to do over the next few years. So you need to get a feel of how they're going to do and how they're going to do versus inflation. Because what will happen is if you cut interest rates and surprise the market, okay, if the market thinks that you shouldn't cut rates and you do, normally your currency goes. Okay, so it's all about keeping your rates in equilibrium with everything else that's going on in the world. And it's, you've got to look, your foreign investors, particularly your longer term bond investors, are very worried about your real yields. So they're looking at inflation, they're looking at your interest rates, and then they're comparing that to all the other countries around the world. So the most important thing is don't surprise the markets, and rather be cautious. So actually, weirdly enough, if we don't cut rates tomorrow, it's probably a good thing from a Rand view type perspective, because foreign investors will then go, geez, the South African Reserve Bank is doing a good job. They really want to knock inflation on the head. As soon as you start getting a little bit too ahead of yourself. Now, I don't think it's a bad thing if they cut rates, but it's actually doesn't, I'm far more interested in what they say after the meeting than what they actually do tomorrow or this week.
Still going to put money in your fund then. Question from the audience, Phil, and I mean, with your history, other than being very good on the fixed income side, you're also involved in asset allocation from where you came from, also at PortfolioMetrix. Question from the audience, very interesting. Given your positive outlook on South Africa, what would be the reason to choose SA bonds above SA equities at this stage?
It's not about one versus the other. I think what's quite important to understand is South African, like US Treasuries as an example, are a risk-off asset. Okay, so if you're looking at US equities or US Treasuries, when US equities get smashed and the world gets into a bad place, US Treasuries will probably do well. SA bonds are actually a risk-on asset. So they tend to do well when the dollar's weakening, the growth is going on, the rand's strengthening. So actually, SA bonds will probably do well when SA Inc. equities, SA companies and property and that are doing well as well. So it's not so much one versus the other. So like in our strategic asset allocation, as an example, when we went offshore 2 years ago now, we did the big switch from SA equities to global. We actually increased SA bonds because it still gave us a way of playing if SA does well trade. But it also allowed us to sort of still hold global equity. So as much as we've got a good global equity exposure, SA bonds, my point is, if you go, it's not I must go into bonds, and if SA equities do well, damn, I've missed out. It's actually, they will probably both do similar at the same time. And it's more, I'd say, in your strategic asset allocation, you might want to be overweight SA equities, maybe versus global at this point. But you probably, who knows, that's maybe your view. Or maybe you just want to rebalance and bring some global assets back into SA equities. But SA bonds should do well at the same time when SA Inc., SA as an entity does well. So it's more about, I think, in your strategic asset allocation, you should probably do both.
Very valuable comments. Thanks, Phil, for that, Matthew. I think Phil set you up there perfectly. Question from my side, Matthew. I mean, the biggest headwind, I think, for SA equity, and you can correct me, is net flows. I mean, we've seen massive outflows on the SA equity market, and it's still continuing. We haven't seen those flows coming back in yet. You know, and that seems to be a going concern. And there's also now that phrase going around, you know, the Trump trade, and my understanding of that is, you know, dump everything in the rest of the world and just buy US stocks because he's going to make America great again. How do you see that play out? I mean, are we going to see, or can we expect net flows back into the SA equity market? And does it matter? Do we need that to actually see SA equities to continue to do well?
Yeah, so look, it's an interesting question. And I mean, if you look at flows, there's a number of ways to look at it. I mean, post the election, I think everyone expected foreign investors to come back and, the rally would continue and things like that. But I mean, if you look at actual positioning now, I mean, you've got locals, particularly in the balance space, pretty close to max offshore. I don't think many people have brought that much, money back to invest in South African equities because they think they missed it. I mean, if you look at, we track the share registers quite closely in June. Foreign investors didn't really come back. There were one or two stocks they came back into, like a Capitec, and that's why you've seen a decent rally on a relative basis there. But if you think about the rally of this 20, 30, 40% in some of these domestics, it hasn't been driven by many people. It's been a few locals getting more positive, and maybe some people closing some underweights. There's this argument in the South Africa, in this emerging market. that South Africa is only 3% now, and foreign investors can just forget about South Africa and it's not a problem. I mean, that argument was very similar to the argument to what people made about oil when oil went to 3% of the S&P in 2020. And when 3 becomes 4, it becomes 5. Then people are forced to chase it. And I think it's also important to say that in the South African market, everything's a relative game. I mean, when you look at the rest of emerging markets, it's not like there's massive, everyone's doing well. I mean, obviously you've got India, which is extremely positive. I mean, people are skipping China. You've got the Brazil government now messing around in the central bank. You've got Mexico taking a big pivot left. I mean, the bar is extremely low actually for South Africa to get inflows. So maybe it takes a little bit of time, but I mean, we're still constructive that flows will come back into the South African market. May just take a little bit of time. But the bar is extremely low. Do we need to see flows coming back? Yes, I do think we do need to see for a further re-rating. But when local investors are maxed out and foreigners have already left, I mean, there's very little money left to leave South Africa. And I think it's an extremely, if you're sitting at 40% offshore, to go to 45 now, are you gonna put money into offshore markets at this sort of rand when you've probably got the best outcome possible for South Africa and a tangible path to growth? I don't think you are. So while we're not seeing massive flows into the South African market, we're also not seeing flows out. So this rally has been driven by a very small portion of local asset managers, and the door's still extremely small when you do see these foreign investors come back. I mean, as I said, the only stock that we really saw material buying was Capitec, and you've seen massive outperformance in Capitec. So we're still relatively constructive. Maybe it takes a little bit more time, but we do think the flows will come back.
Capitec's very interesting because, I mean, on your holdings, it was one of the holdings that you've got a big underweight position to. And Capitec's very interesting to me because it seems that some fund managers either love it or you hate it. You've got an overweight position to Absa. But just in terms of your thinking, Capitec, why the big underweight then?
Yeah, sure. I mean, look, it's always just been on valuation grounds for Capitec. I mean, when we look at these highly rated stocks, and we also hold stocks like Shoprite and Clicks and a number of these highly rated businesses. I mean, our big focus when we are investing in highly rated businesses is, will the earnings be there and will they be able to beat consensus? Our view, and it was right last year, that Capitec earnings were too high and they did get cut. The market just re-rated it into earnings downgrades. So it was just a valuation call, and we didn't think the earnings would be there. The market just looked straight through it. So it was one of those unfortunate ones. But I mean, we have held a number of these highly rated businesses. Clicks has done well for us. Shoprite's done well for us, and ultimately our view in South Africa, and it has been proved right so far, is a rising boat. I mean, a rising tide lifts all boats. And it's been relatively good for all domestic equities, and that's kind of our view going forward. Is it's going to be less about stock specific calls in South Africa and whether we could go on this path to 2, 3, 4% GDP growth. Capitec's in a lot better position than it was from an earnings momentum point of view now, but we were concerned about earnings downgrades. It did come through last year. The market just re-rated the share.
Phil, I'm not ignoring you, but I just want to continue this conversation really quickly with Matthew and staying to stocks, and it speaks to one of the questions from the audience as well. And you hold Process, you hold Naspers, you've got exposure to Tencent. So the question from the audience, if Trump were to come in or were to be elected again as president, what will the impact be on trade tariffs again, things like China, and the impact on stocks like Tencent?
Yeah, sure. So look, I mean, a big focus, and it's actually quite important at the moment, is what's happening this week is the China plenary. And we think that's extremely important. I think what we need to see is China coming out with reforms that are more inwardly focused and are able to boost consumption domestically. While it is obviously a bigger issue with Trump, it's a bigger issue globally now. You're seeing tariffs go up in the EU as well, and ultimately, the world's not going to accept China exporting all its excess capacity, into eternity. China does need to boost consumption domestically, and this plenary this week is going to be very important on whether China can pivot to being more inwardly focused and to boosting consumption domestically. I mean, I just got back from Shanghai this week, and you know, everything is, you know, in terms of infrastructure and you know, property and stuff, it's not actually looking that bad. The big issue China has is just sentiment within the country and, you know, actual consumption domestically. So it needs to change those sort of things. And, you know, I think Trump potentially being elected expedites that. You know, they can't be exporting this excess capacity, and Trump's going to come down hard on that. So let's see this week, and then, you know, we obviously take a view from there. But I think, you know, this week and this plenary, and then plotting the reforms going forward, I think is extremely important in the whole Trump, you know, debate for China.
Interesting indeed. Phil, to come back to you in our conversation that we had earlier, also speaks to a question from Michelle. So positive on SA bonds, positive on SA equity. But Michelle is asking specifically, you know, that if you are positive on both SA bonds and SA equity, does bonds not come at a lower risk premium than SA equity? Or how do you understand that?
I mean, I wouldn't say I'm positive on either, actually. That's not my job to, you know, it's far rather say, well, okay, hang on. If things go well, I think SA equity will do really well. But, and again, what's SA equity? Okay, so South Africa, if South Africa starts doing better relative to the rest of the world, there's some South African stocks that won't do well in that environment. Of course, most of your earnings is offshore.
Yeah.
So it's okay, well, in a good scenario, I think bonds will do really, really well, and equities will probably do a lot better. If things turn around like they always do, if something happens around the world, you know, someone gets assassinated, someone, you know, there's a lot of troubles out there in the world as well. Things can knock this over. Most importantly, I think the range of returns was really my point, is if things go wrong from here and you're buying bonds and you go, you know, Troy's saying there, well, shut up, I'm trying to convince these clients to buy bonds. Most importantly, if you go wrong, things go really bad from here and you have rate hikes and the land blows out, you're probably going to do 8%. Over 12 per year over 2 years. 3 months, anything can happen. It'll be a bit of a wobble around. We actually have been selling bonds, believe it or not, in the last few days into stupid, crazy strength, okay? So the point is you're always working around that. But most importantly, I sit with a different lens here. Like, I look at my mom as an example, similar to probably Troy's client there. She's retired, she's a widow, she needs to live with an income, okay? She doesn't really have the time horizon or the willingness to hope that equities gives her 25 and maybe something goes wrong in China and it goes the other way. So it's more looking at it like, okay, if you need a decent income, you want a decent return, but you just don't have the stomach, the volatility, or the ability to take on the risk, you can still get sort of inflation plus 4, 5, 6, you know, and if things go wrong, you're still going to do decent high single-digit returns. So it's more about a range of returns. So again, it's not like to be positive on SA or positive on the globe, that can get in the price and come around. It's more saying, okay, well, if things go well, we'll do this. If things go badly, we do this. If things go badly, we'll probably still be happy. We'll still be high single-digit returns probably from this sort of level over the next couple of years. And at the end of the day, bonds are like glorified fixed deposits. If you think bonds are going to do really well, and they're going to do really well, the point is valid. You should probably be buying some SA Inc. stocks and property stocks as well. But if it doesn't do well, because the world changes quite quickly on you, then just be prepared for that. So as a longer term investor, I still think that I can't tell you what equities are going to do over the next 12 months or the next 2 years. It's really almost impossible. But I've got a far greater ability to do that when I'm buying fixed yield instruments. And the volatility in the bonds is more like turbulence on the airplane. It comes and goes. At the end of the day, I'm not in it for capital gain. It's in it for yield. I often give the analogy of fruit coming off the tree. This is not about growth in the bonds. It's about what income are you going to get. And the income we're getting right now is much higher than cash and inflation, and interest rates are likely to come down. So actually the environment should be better than it was over the last few years.
Well, and I think the name of the fund actually nails it. It's the Dynamic Income Fund, and actually says exactly what you're doing in the fund. Matthew, just very quickly back to SA equity. We focus on your SA equity fund, with pure SA equity fund, but you also have the general equity. We've got some global, and you've got the flexible mandate as well. In the other two mandates, just to test your views on global, you've showed in the SA equity space, you decreased the rand hedges, increased SA Inc. But what are you doing in the other two funds? Are you starting to repatriate some of the global assets back into SA equity? One of the questions I think a lot of audience and investors are wondering about, do I start to repatriate more of those global assets for SA equity?
So, I mean, particularly in the flexible fund, we did pull some money back. And it's also not just about pulling money back. It's also the South African market is, 50-50 rand hedge commodities and, 50% domestics. So it's not just a question of, are you pulling money back? It's also a question of, are you shifting, a number of your rand hedge exposure to your domestic equities? And I think we've done that across the board. We have pulled some money back in the flexible fund, and then in the general equity fund and the flexible fund, we moved quite a lot of rand hedges into domestically focused equities. So we had some exposure, or at least more exposure to a rally there. So all funds have done relatively well over the first 6 months of this year, and hopefully it can continue.
That's the very last question from the audience. Gold also had a significant rally in your presentation. You are constructive in gold. A question from Stefan specifically: if you're constructive in gold, why is Gold Fields not then one of your biggest underweight positions?
Sure. I mean, it's just been a relative call. I mean, we've been overweight Anglo Gold, underweight Gold Fields for quite some time. With Gold Fields, they've got a project that they're ramping up called Solaris Norte. And ultimately, we're still concerned about that project and the ramp-up schedule. It's been death by 1,000 cuts. They've already delayed it 4 or 5 times. And I mean, and ultimately for us, we don't believe that the medium and long term, steady state guidance is correct. We don't think they have a good handle on it at all. And until they kind of, until we kind of see the ramp up, until we see them cutting medium term guidance, it's very hard for us to get that constructive on Gold Fields when we know, or at least we have a strong view that there's still bad news coming forward. I mean, it would have been a lot easier if, we just got one massive cut, they changed long-term guidance, and we could just move on with this. But this constant cutting on guidance just makes us feel that they don't have a great handle on the project. And there's obviously a few other issues with from an ESG perspective on the chinchillas and stuff. But our view is until you see that medium-term, long-term guidance get cut for Gold Fields, we still think at every results, you're going to kind of be holding your breath, hoping that you don't get bad news. So it's just Anglo Gold's just a cleaner investment story for us. And I mean, when we look at gold investments, we're just looking for companies that are going to try and track the gold price, as close as possible.
Like that, definitely. Very positive on SA equity and SA fixed income. Gentlemen, thank you so much for your time this morning. Unfortunately, the clock caught us, but we managed to get through all the questions. Fantastic. I see Alan Geddy from PortfolioMetrix also on the line, responded to some questions in the Q&A box. If you want more information on the PortfolioMetrix BCI Dynamic Income Fund or 361 BCI Equity Fund or any of their funds, please get hold of us or any of the teams at 361. Jackie also on the line, or PortfolioMetrix, Phil and Alan. Gentlemen, again, thank you so much. It's been extremely insightful indeed. I do like what you're doing in your funds. For our audience, I mean, if you wonder what to do with duration, I mean, let the experts manage it. The PortfolioMetrix BCI Dynamic Income Fund, Phil's illustrated, has done a terrific job with that for many, many years. And if you buy the SA Equity Story, 361 SA Equity Fund, phenomenal track record and showing that they can allocate to SA Equity. Gents, again, thank you so much for your time. It's been a real privilege and a pleasure to have you on board. Interesting conversation this morning. To our audience, quick reminder, next week, Wednesday, 24 July, where we have discussions with Optimum Investments and Platinum Portfolios. Thanks again for your support, and we'll see you again next week, Wednesday. Matthew, Phil, have a super week further. Thanks.
Thanks very much, Eugene, and thanks everyone for tuning in. Cheers.